Ladies and gentlemen, welcome to the Fintech Frenzy. So, usually I do not do the Fintech Frenzy on Friday. I was not available yesterday, so we pushed it to today. And with that has come a lot of news. There was a developing story over the last couple of days that, well, I was taking sort of a day off from the show, has allowed this story to develop even more. And I wanted to cover this for you guys and talk about SoFi's implications here because I think that they're getting much more drastic as time goes on. So we're going to cover that and then get into some other news around Robinhood, around Coinbase, around some other separate SoFi conversations. And then we'll head off into the SoFi Weekly, which is a separate show in about an hour and a half from now, or an hour after this show is over. But we'll try to make it short and sweet for you guys. How's everybody doing? Jay, good to see you, my friend. Sean, hurt me, SoFi, one more time. Okay. Yeah, Mike, Steve has been blowing up my phone about the different options that he's been playing and how he's getting out of sticky situations and all this stuff ever since I said that I was interested. If I could take just a quick, little pause real quick before we jump into the SoFi stuff, just to talk about options, not in option strategies or anything. If people weren't around for the last Fintech Frenzy story that we got, we talked about how I never really got into options. A lot of that was due to the brokerages that I had available to me here in Canada and the ones that I've been exposed to, just not having great level one option, the ability to actually make those contracts. So now that I'm learning it, there was a little bit of a separation yesterday from the comments saying that there is risk and other people saying that no, it's actually pretty risk-free. Fully aware of the comments and the DMs that people have been sending me viciously about different styles of investing. But I'm aware that there's risk. It's not a golden egg, but still could add to my playbook for different strategies over the next coming months or anything. But I'll keep you guys updated on what I'm doing, with my portfolio, with different stocks that I hold that could potentially work well for. So it could be another, tool in the toolbox, the tool belt, whatever you guys want to say. All right. So let's jump into the main fun story of the day, which is the meltdown that banks have been going through over the last couple, maybe week and a half. Maybe it's been 2 weeks, honestly. So if you guys don't remember, Synapse was a banking as a service platform that connected banks with the fintechs that they were working with to create card programs, to set up deposit accounts, to send up lending services, very much like what Galileo does with its supporting banks and including SoFi itself. Galileo being a subsidiary of SoFi. It's their technology platform. Only difference is that Synapse ended up just simply going away. They essentially went bankrupt and didn't really tell Evolve, which was their main partnering bank. And this has led to this massive fallout and looking in from regulators to a lot of these banking as a service banks that make a lot of their revenue from bringing on customers that aren't necessarily banking directly with that bank itself. So having a relationship with Evolve Bank might be through something like Shopify or through Affirm. Like if you have an Affirm card, you're actually partnering and getting that issuing card from Evolve Bank. Okay, there's other partnering banks as well, but really, that's the main sort of point there. Once Synapse actually started to go through its bankruptcy, okay, then Evolve Bank, which supposedly had nothing to do with it, and I'm not actually accusing them of having that, but then they started to get looked through a little bit, and then they also received a cease and desist, not cease and disorder. A cease and desist of their practices because supposedly they weren't up to date with a lot of their compliance sort of programs that they've been going through. So they've been told to start to upgrade or update these. They have all these different step processes that they have to go through. And a lot of it is actually surrounding their banking as a service solutions. Now, the important part about this, and the reason why I think that this is sort of very important for the story of SoFi and Galileo, is that they are some of the largest players in this space. And that knowing that, these other very large players, now there's a lot of them, okay? Like a lot of very small banks that play in this area, because it's a nice way to add on a good chunk of revenue. But Evolve was a very big one. And the fact that they are now getting these cease and desists is kind of indicating of maybe that there are some regulators looking into this. Now, as of, let's see how long ago this was. Where is it? I just had it up. Yeah, as of earlier today at 9:43 a.m., I saw a tweet come in that says Thread Bank, which supports 35 separate fintech programs through direct partnerships and relationships with middleware, is also now going to get a consent order. Regulators are looking through them. The exact same thing for compliance and making sure that they might get a slap on the wrist for being sort of behind the times and not maybe doing whether it's know your client, know your product, AML. Who knows the exact purposes just yet? But they're also getting slapped now. Very interesting. Then I hear another thing. Talk about the problems with dealing with some of these large banking as a service banks that aren't, some of the biggest ones. Look at this. According to Jason Mikola, well, not just according to him, this has been confirmed by, hundreds of sources at this point, but this was one of the first ones. Evolve Bank and Trust has allegedly been the victim of a ransomware attack and data breach by Russian hacker group Lockbit. Now, if you guys are a client of some of these large fintechs that they work with, Mercury, Stripe, Affirm, you will have probably already received an email saying, hey, time to change your passwords, time to, potentially order a new card, get new numbers, right? Because you could potentially be subject of one of these, data breaches. So look at this. I've got another one just to show you the absolute size of this. This is also from Jason. He's been keeping up on this story, being by far the best fact checker for this story. Look at this. 9.9 gigs worth of data that has been released. People's transactions, people's passwords, people's emails, everything. It's a massive data breach. Affirm's own CEO is now, reaching out to clients saying, hey, this is the steps that you need to take. We are fully aware. We're working around the clock. Even Max Levchin has been live on Twitter saying, this is extremely serious. We're trying to take this as seriously as possible, but there's not much that we can do because it's a little bit out of our hands working with these partnering banks. So the interesting part to me is, and look at this. Let me share one more. This was from Jason, once again, sharing his own stories of this. This even hit Wise. He shows that his own bank has been subject of this data breach through Evolve Bank and Trust. And Wise is now starting to lose some clients or losing their clients, personal information because there was this massive data breach. So whenever things happen like this, it usually brings on an unbelievable amount of compliance. Regulators look back and they say, what did we do wrong? What could have been stopped here? Could it have been stopped at all? And how do we make it from not happening again? Now, if you guys had watched it might have been 3 weeks ago, we had listened to one of the very high-end product directors at Galileo talk about how security has been their number one focus always, okay? And that it seemed kind of silly for a long time while the grass was green that security would be your top focus. But then during really hard times, it's like, all right, well, maybe it's time to switch providers and actually go with, some of the bigger names that might actually have security as some of their more top solutions. So with a lot of these fun fintech plays, or pricing plays where you can end up going into these solutions based on new features or lower pricing, it's all great until it isn't. And it's showing right now that during these times of potentially data breaches or bankruptcies for some of these banking as a service providers, for Thread Bank going down and literally not going down, I shouldn't say that, but part of the consent order that was actually issued, they literally stated banking as a service and lending as a service as points that they wanted to reflect on, which according to Jason is a first of its kind. So they're very much focusing in on these areas, and SoFi has to benefit because if they want to be, one of those actual banks, they have those licenses in place and they have the tech platform. So there's no third party risk, right? They own it all in house. Having that to issue that out to their own providers, Galileo's been safe through this process. SoFi has been safe through this process, unlike all of these other fintechs that people have, sort of left their money with, right? And so I think that that's a big difference that people will sort of try to hone in on whenever they're picking their next neobank or something like this, that you really do want to be with a bank directly. It's just whether or not SoFi is going to reflect that in their member count growth. And then hopefully their tech platform seeing new fintech programs get signed up based on, these exact problems. I also wanted to show off something, but anyway, about 3 months ago, speaking of how great, the tech platform is for SoFi, let's take a step back real quick and show some pain really quickly. I know I've been a little bit bullish on SoFi, so we have to take a step back for you guys. Jeff Courier. Anyone recognize this name at all? He was the chief technology officer of Galileo Technologies. So not of SoFi. Okay, that's Jeremy Rischel. But now he just left 3 months ago to go to Chime. Chime's been making moves. They're doing the Robin Hood play right now. They're making acquisitions. They're taking talent. They're making money moves. But obviously that doesn't mean that SoFi is sitting here with their pants down, not also getting talent as well. But those are some things that I'm going to have to look into and see who are the new names on SoFi. I just saw that today. Someone sent that, and I thought that was an interesting story as well. Hello and welcome. Welcome in. Hello, Jarrett. SoFi about to recover? I mean, maybe. It very well could be if they can show any level of taking advantage of the moments that are being shown, and especially whenever it's very quiet, like the time that it is right now. I do actually believe that they are working very hard. Some people think that they're sitting on their hands. I mean, we'll just have to see from the quarters that come out how well that they are doing. Because there's a lot of work that SoFi can do that isn't going to be published in, press releases and stuff like this, where, it's not new SMB banking or brand new premium credit cards that are being put out, but it could be large relationships with financial institutions that they are selling their loans to. That would absolutely change the quarter, right? Galileo clients that they're signing up, that could be large financial institutions. That would change the quarter. And so, however, if they are signing up those things, we would have known for, a long period of time, but it could also increase the pipeline going forward, which quarter after quarter, SoFi has said is stronger than ever. So, I think that the people who are right now getting extremely bearish on SoFi are a little bit too early to judge this. I mean, the stock has given no real reason to want to sell other than the stock price. And just data-driven investing points this out like every day, I think, to his countless haters that don't like his commentary on SoFi. Even though it's probably widely known that he's probably the smartest name in the stock. But anyway, he always brings up this thing that stock price is the most tracked metric and probably the least useful, right? So pay attention to what SoFi is actually doing, what the financials are actually looking like, the members that they're bringing on, and let's compare that to the sentiment that, you know, the overall investor base is giving us. I saw recently a comment saying, the stock deserves to be at $3. I saw someone, I'll make you a bet that they make around 320,000 new members this quarter. I was like, I'll take that bet all day. They haven't done that for years. We have no reason to believe that member counts are going to drop off in any significant way. We're not seeing that in website traffic. We're not seeing that in their ads. I mean, they're actually doing marketing like crazy right now. I see them all over YouTube. I see them all over sports. I mean, every single sport. I think quite the opposite. I think that we could see a real boost in member growth right now, and actually maybe bringing down average revenue per user because we might see such a large spike of new members. Remember, we're still in this period of 2024, 2025, where we're supposed to add on about 1 million new members in a quarter during this period. That's management's predictions, that they think that they're going to break that milestone within the next 18 months or so. So, yeah, I mean, if we are going to break new milestones, should we end up breaking, sort of limits on the way down? I don't think it works like that. People want to rate us at as a bank, but I think we're growing way too fast to be a bank. Well, we are a bank. I'm not going to downplay it like this is not a bank. People get caught up in that argument. We're a bank. We're just a very fast-growing bank. So do very fast-growing banks deserve premiums? Well, according to Nubank, according to Revolut, yes. Yeah, they deserve unbelievable premiums because they're businesses that can end up growing, lower customer acquisition cost, increase lifetime value, lower churn, just like any other SaaS business. The only difference is that there's a much higher margin and a much higher chance of default on the lending products. That exists across banking. But that doesn't mean that you don't end up giving them premiums if they can end up holding those default rates to levels that are perfectly appropriate. If SoFi can do that, if they can give the investor base any real reason to believe that defaults are actually going to sort of level out or decline, as they've been talking about, new cohorts performing better than their old cohorts, then we're going to see, significant improvements in the stock. And we're already seeing that a little bit whenever you see people like Markets with May, another tracker of this stock, very smart, tracking the ABS markets, okay, showing that the sales that SoFi has done of their different loan books. So you can sell those loans to, like, in secondary markets, the same way you can buy and sell stocks. You can sell those loans to other institutions that may want to buy them, and they're getting increases on their rating of how safe those loans are to some levels of, C tranches of AAA. That's unbelievable. I mean, that's very exciting to know, because then in SoFi's newer cohorts of their personal loans, they can then demand a higher premium, right? Because they've said, hey, our past cohorts have performed well. We obviously have a great reputation for underwriting these personal loans. We want more because the chance that you are going to default on these loans that we sell you is potentially a lower chance of happening. So if that's the case, that means maybe the gain on sale margin ends up going up, right? So a little bit of the boring accounting part of SoFi that retail doesn't like to focus on, and in some degrees, I do think that it's an important step, however, very hard to monitor in certain cases. But still, as long as you get sort of a framework of, hey, is this deteriorating or is this getting better? It gives you enough framework to sort of, you can kind of brush off the sweat and say, hey, you know what, SoFi's still going in the right direction. And from everything that I've seen, they are very much going in the right direction. How is my favorite third person in Canada? Who are the two above me? Not a lurker. I want to know. Breaking news. Convince my wife to switch to SoFi and collect some deposit bonuses and saving interest with added relay benefits. Happy tears. And a lot of it is going to be that. I think that the future of fintech is not only just going to be growth of word of mouth like any other product, but then it's also going to be able to get, youth accounts, right? Where do people have their children sign up and continue to bank? Well, it's usually just the account that your parents signed you up with. So really what makes SoFi, in my opinion, a safer stock than most is knowing that there's a lot of tailwinds for SoFi very long term, right? QED just put out another fintech report for 2024 talking about how they believe that the revenues that fintech is making right now, about $300 billion globally, is still expected to 6x by 2030. Holy shit, right? And they break it down very easily. If you're digital only, you have lower cost to operate, you have a lower cost to acquire customers, and you have a much faster speed for applications to get people on the platform instead of having them to come in and give all that information very slowly with some sort of advisor that's very expensive and time consuming. Now, if people can end up doing the same process that they can online as what they can in person, people are going to switch online because it's more convenient and you're going to save money doing so. Lower account fees, higher APYs, save on gas, save on time. It's a brainless solution that branch banking is going to die. Okay. And now I don't think that every branch is going to go away. I just think that they're going to turn into big, supervised safety deposit boxes, essentially. There's reasons for vaults to be set up at certain locations so people can go and drop off their valuables that are not at home and are better protected. But it doesn't mean that you're going to go there for financial advice, that you're going to go there to sign up for a checking account, to have your kid set up an account there. It's much easier, much safer to have that stuff done online and to have, parental accounts set up so you can monitor your kids' spending and control their credit limits whenever you give them a card for spending. It's the new age. And if you can't see that, good luck to you. And if SoFi is growing market share in every single product line that they have, this is not me saying this, this is management. In the last 2 quarters, they've repeated this segment. In every single product line that they have, that they are growing market share, how do we lose? How do you lose money on this stock if that's what's happening? Right? See, growing market share does not mean growing. Growing market share means you're growing faster than your competitors. So the market can end up growing because there's more money in the system, there's more people in the system, right? Population growth, money supply growth, whatever. But then taking market share is saying, hey, the Chase Bank customers are coming to us at a faster rate than they are getting new signups. Okay. That is very interesting. Try to find companies that are doing that while expanding on margins, and the market can't see an aspect of their business, and you have an absolute banger of a company. That's the equation. Okay. Yeah. Like, I don't know how else to explain it. So if the market doesn't see it, they're betting on the fact that, SoFi is just like JP Morgan. But then that would mean that they're growing at the same rate as what the market is growing at, or even less in the case of the incumbent banks. No, thank you. I don't believe it. I call your bluff. All right. New is like JP Morgan. How is New Bank like JP Morgan? I want to know. How is New Bank like JP Morgan? And speaking of large incumbent financial institutions, I want to bring up this story because Amit is breaking a new story on his Twitter right now. And I have no confirmation that this is right. I'm going to trust him because the information that he puts out, he does want to fact check. He does want to be absolutely right. And he's not just going to let, things like this fly without checking multiple sources. Legacy platforms like Charles Schwab are now offering certain clients 1% to not transfer their portfolios to Robinhood. Two sources confirmed to me today that they're trying to transfer their accounts from Schwab. Today was the last day to take advantage of Robinhood's 1% match, and Schwab personally called them and offered 1% to stay. Geez, they're doing this on large accounts as well. Absolutely crazy. There's going to be signs whenever fintech starts to win that you're going to see these moves, right? We're strong, all the incumbent banks are very strong and everything like this, and they're all going to have great margins until stuff like this happens, right? Even Jamie Dimon himself has said that we cannot keep our margins up because we are going to have to fight against these fintechs that have much lower margins and much less what do you call it, like responsibilities in terms of dividends to shareholders, buybacks, and into their clients, right? So there is going to be margin compression for sure. Robinhood gave me an offer of 0.05% APR percent extra to deposit. What do you mean APR? APR is what you pay. APY is what you make. To deposit 100 cash and 1% for all the money I switch. 0.5% extra to deposit 100 cash. Your wording is awful there, Dream. Are you saying they're giving you 1.5% to transfer your money? I keep all my stock certificates in a safe deposit box at Chase. I visit them once a week and talk to them. Why? Why? You're paying for a safety deposit box so then you can keep paper certificates of your stocks? So are we buying more SoFi or not? Give me the too long didn't read. So here's the too long didn't read. Banking as a service, I believe, is going to have way more crackdowns, way more compliance. Okay. So that is going to be from two different fronts. One, the middleway software. So you can say the likes of Synapse or Marqeta or Galileo, and that will happen. Okay, because there has been a scare and clients do not want to get burnt. So I think that is going to trickle down into more regulation. Always going to happen. It's in my opinion that Galileo, specifically the tech platform, has taken the security style approach and compliance approach. So they will be perfectly fine and will actually be well suited for a new framework in the way that, being that middleman software has been so far in this banking as a service game. Now, for being the actual deposit style banks that are receiving the money from these fintech programs, I think that there's also going to be a new layer of compliance. Now, SoFi isn't really in this game too much. They're not taking on a lot of deposits from other financial institutions so far that we know of. But they will get in this game like any other fintech or like any other large bank would have, right? And in that step, the fact that they are a fully regulated bank means that there will be a business where a lot of other banks will have failed or take large fines for doing so, that SoFi could then benefit off of and say, hey, we can do this for potentially a lower price or potentially a more compliant style, that because we are a traditional fully licensed bank, and we have the middleman software, so we can kind of bundle this and add to the pricing. A TLDR of the TLDR is that SoFi is more likely to benefit off this than not. And then I'm hoping that they end up getting deeper relationships with financial institutions, with fintechs, and potentially even win some clients after what this whole debacle with Synapse and a Thread Bank and Evolve has ended up happening over the last little bit. Tanner, don't you think that this all bodes well for Galileo and ultimately SoFi? Yeah. Yeah. They should be selling themselves right now. And the thing is though, is that the channels that they are using to sell themselves is not necessarily the ones that we're looking through. So is it X that we're expecting them to sell themselves on, or are they, setting up sales teams and going directly to these fintechs, like Affirm, for example, or like Dave, or like any of these other ones, saying, "What the hell are you doing?" You know, you just let all of your clients with Affirm cards, all their information, all their emails, passwords, everything, all go loose. Guys, you went to a company that is a much smaller team that's well less funded. Like come to us. We're taking this shit seriously, and we'll show you how. We'll show you why we're doing it right. And if that's not the case, then they're not going to benefit. But if that is the case, there is a real probable chance that they walk out here ahead. Does Galileo have salespeople? Yeah, yeah. I think it's pretty safe to say that every single software, like as a service, has salespeople. Every single one. You ever seen like those buttons that say "book a demo"? That's what that is. If it says "book a demo," they got a sales team. MFA's under $100. Can you do a video, please? No, no. I'm not even going to look that direction while rates are still high, and I'm willing to take a 40% premium on that stock to buy in. I know that things are on the right track and corrected. If you want to get that extreme discount on stocks like that are, you know, so heavily beaten down, just to give you an insight into how bad solar's doing right now. Fucking, excuse me. Tesla is not even showcasing how much solar they've even deployed last quarter. They just took it off their books because they're like, the number's getting so bad that it's going to look silly if we even show a number. So let's just show our other statistics instead. Yeah. If you could change one thing about the business model of SoFi to make it a better investment, what would it be? One thing about the business model. Um, I don't know. I'm not happy the way that they've done credit cards. They seem to be happy about it. But credit cards are an unbelievable financial product. Unbelievable. And they have seemed to have had a rocky start. Yeah, it's not going to be options for me. I'm going to care more about SMB banking, credit cards. I want level one options just so then the people in my own chat can stop bitching about it. But aside from that, no, I don't think that that's as much of a deal for me as some of those other financial products are. Covered calls are super high risk. Noto knows this. All right, ladies and gentlemen, that is the show. Come back if you want to see more SoFi, if you want to see some a little bit more insight from Roy or from Tevis. We might have a special guest. I heard he's debating on coming on the show. No guarantees. That's my dog. Her name's Raina. Until next time, really do appreciate you guys. But bye for now.